everybody. Welcome to the Closing Bell. I'm Kelly Evans on this Thursday at the New York Stock Exchange.
And I'm Bill Griffith back here at CNBC headquarters. We'll explain why a little bit later. Markets continue to trade at or near all-time highs. We're watching for a batch of very important earnings due out. I know we say that every day, but this is a big
group. Big week.
Yeah. Big group coming out tonight could drive the rest of the week. We got Amazon, Visa, Starbucks, Pandora among those set to report just after the bell. A lot riding on those earnings, and we'll have them the first with the best analysis that you can find.
Yeah, that all starts after the bell. And then after that, in exactly 2 hours, President Obama's exclusive interview with our Steve Liesman will air in its entirety right here on CNBC. Steve is going to join us on the show beforehand to tell us some of the highlights. We do know the president wants to talk about tax inversions, letting it be known he will support legislation to stop companies from reincorporating overseas to escape the 35% tax rate here in the U.S. So we'll get into that with Steve and much, much more as the president and Steve Liesman get into it over the economy.
And Melissa Lee and I will be anchoring a 5 o'clock special on that.
That's
coming
right.
up.
It's a Bill sandwich today.
Looking forward to that. Yeah, exactly. Lucky you. Also, 2 big CEO interviews just ahead. We have Dunkin' Brands boss Nigel Travis. Their earnings disappointed. That stock is down today. JetBlue's David Barger will be here on the Closing Bell. Both had interesting nuggets inside their reports. You'll want to hear from both of these CEOs, and you will, coming up on today's Closing Bell.
So let's look at where we stand in markets right now. An hour to go, and the Dow Jones Industrial Average down again today to the tune of about 21 points. Remember, yesterday it was the lone major index to sit out of the rally that took the S&P to new highs, but today giving up some of those gains as the broad market index is off by about a point. The Nasdaq, meanwhile, off about 4. As Bill mentioned, we're waiting on some key components of that index to report.
All right, here we go. Let's talk about all of it in our Closing Bell exchange today. With us, CNBC contributor Heather Hughes from SunAmerica Funds, Jim Lowell from Advisor Investments, Larry Glazer from Mayflower Advisors, Drew Nordlicht from HighTower, and our own Rick Santelli. Drew Nordlicht, I see here, it says here you're building cash. Question 1, why?
Yes, we are, Bill.
Why? And 2, where are you building it from? What are you selling to build cash?
So, Bill, we're maintaining a diversified approach across portfolio accounts, keeping allocations to equities, to fixed income, to cash and alternatives. As new cash has come in from cash-generating investments, we're keeping it on the sidelines. Our concern really is the lack of volatility in the marketplace. We've gone 1,022 days without a 10% correction. That's the 3rd longest in 25 years. And a lot of that is really geared towards the fact that the Fed seems to have outlawed volatility. Investors are continuing to pile money into equities with the assumption that the Federal Reserve is there, it's going to be there, but we have 3 more months, and then at that point, the Fed is out of the way. If you look at the last 2 times the Fed has exited quantitative easing, we've seen downdrafts and increased volatility.
Okay.
Right.
That combined with the election, and that combined with valuations getting stretched. We've moved from 15 on the PE basis for the S&P to 17.5.
Okay.
We have concerns. So we'd use any type of downdraft as moments to add to equities.
Okay, so you're building cash to wait for that downdraft, perhaps. Larry Glazer, what about you guys? And by the way,
Sure.
Is it right to attribute so much of this to the Fed, to the market's resilience, I mean, when you have geopolitical events this concerning that are taking place around the world?
Look, no question. Look, this has been a relatively unremarkable earnings period amidst an expensive and extended market. With that said, it's still exciting and creates opportunities for investors if you're looking hard enough. And what we see, those opportunities are really threefold. One is in the traditional obvious plays where you're seeing an intersection of growth and momentum, something like large cap technology, which still looks cheap relative to history, maybe not super cheap, but cheap enough that you can put money in a cash-rich company. Also in turnaround plays, we're seeing an earnings season with consumer discretionary revenues look like they're improving, maybe the worst is behind us with the polar vortex and retail, some opportunities there with valuation checking. And then finally, the down and dirty. If you're truly a contrarian here, you see where guidance is weak and opportunities in sympathy. Caterpillar, terrible guidance going forward. As a result, mining stocks get killed. If you have a strong stomach, you can start to look at those. So market's expensive, but there are opportunities. You got to dig, you got to look while everyone's at the beach.
Meanwhile, Jim Lowell, during this earnings season, that you have to admit the markets have behaved pretty well here.
No question about it. I don't worry about low volatility or the Fed nearly as much as the prior guest, and certainly wouldn't want to be market timing with client cash. The reality is that We see the Fed being accommodative and flexible. That's a good safety net underneath this market, no question about it. But the fundamentals continue to drive us to the belief that we're seeing slow growth, not no growth, not just in the U.S., but even a little bit tentatively inside the Eurozone. And of course, we're very focused on what consumers are doing with their money, and they are buying big ticket items, whether it's existing homes, whether it's cars. We saw Ford deliver its first quarterly profit from the Eurozone in 3 years. So we see signs that the consumer is not down and not out, and unless and until we do, we're going to stay focused on buying managers who know how to cherry pick what certainly is a fairly lofty market.
That's interesting, Jim, what you're saying there about the consumer. Heather, do you guys agree? And where are you seeing opportunity right now?
Yeah, I think it's very interesting. I heard consumer discretionaries. We're hearing if you believe in the contrarian play, that they may turn around if you believe in a stronger consumer. But I don't know that the data is indicating that right now, given housing that we had this morning was weaker, job participation rate still has issues, slack in the labor force or declining wage growth. Is it even keeping up with inflation? Can that help consumers or spending power through discretionary spending? We need an increase in wage growth, I think, for the market to continue higher, even on the backs that earnings revenue is ticking a little bit higher, so that's reassuring. We're not just cost cutting on the bottom line there.
And I agree with that point. At the end of the day, it's earnings that do drive the market, not geopolitical events. If you look at the Israeli stock market, it's up since the conflict in Gaza began because investors are seeing through that. They say this is where growth is really coming from. In a world we're so desperate for growth, we want to grab those technology companies and healthcare companies when they come down. It's one of the few places that's actually growing in earnings season.
Right.
So investors are smart enough to reward that, but they're also going to punish people that don't have future guidance.
Yeah, tell that to the Russian stock market.
Right, exactly.
Rick Santelli, a very good jobless claims number this morning, much lower than expected. Is that why the 10 years back above 2.5?
I think that's part of it. I think there's technical reasons as well. We basically held the low close yield of the year, which was 244 on May 28th. And based on the 62,000 drop in last month's new home sales, we're in the 400s now. Remember, 8 years ago, the high water mark was 1.4 million. And when it comes to the consumer, it depends on which consumers you're looking at. If you look at the affluent, you get one picture. You look at the middle class, a car is now the new house, okay? Right down to the subprime loan that's behind it in many ways. And when I look at the markets, I see some unusual things we should be aware of. The British pound's losing a bit of ground against the dollar. The whole tightening with Mr. Carney seems to be a backtrack. On the China front, their currency now is at the best level against the greenback since March. The euro's at the lowest level on the dollar since November. And we're actually seeing some widening on the credit spreads. If you look at Barclays, whether it's investment grade or high yield, but that's on the 1 month. You open the chart up much bigger, you don't see it. And we don't want to forget there's been huge amounts of issuance since Mr. Draghi, of course, said he would do anything. And if there's a lot of issuance, maybe investors have a limited menu, broccoli and spinach. But if you're hungry enough, you eat broccoli and spinach.
Yeah, that's right. And by the way, I want to go back to Drew, to something that Jim Lowell said is kind of a dig at you, actually. He said we wouldn't want to be market timing with client cash here. And I'm interested in what you would say to that in response, because there are a lot of people sitting right now at conservative positions, waiting perhaps that moment to get in, who have been wrong and caught on the wrong side for quite some time.
Yeah, so Kelly, we're not big fans of plugging your nose and just buying at any time. The reality is that we've seen PE multiples go from 15 to 17.5. Earnings are moving up at about a 5% clip this quarter, but revenue growth is only at 3%. So the reality is we're sitting in a market that's got a lot of financial engineering behind it. The Federal Reserve has kept interest rates low, so corporate America can borrow debt and buy back stock and manufacture.
You don't have any regret
growth.
that you're missing this party here. You're not sitting there kicking yourself that you're missing this.
So Bill, as I mentioned earlier, we do have an exposure to equity, so we're not at a 0% equity allocation. What we're not doing is buying at S&P right now, all-time highs here in July 2014. The reality is you had a nice rally in 2007 that didn't end exceptionally well, and you could have bought that all the way up, and then if you didn't sell or if you didn't pick your points, you ended up hurt by it. So our point of view is that right now volatility is low. Right now earnings are not accelerating at the pace necessary to support a 17.5 handle on a PE ratio.
But is this 2007?
Is that a good point?
Drew, are you saying this is 2007 all over again?
No, I'm making the analogy to the fact that you have markets that go pushing to all-time highs, that's the last time we experienced all-time highs.
So it's very
And
simple.
what he's
You
saying
just
is
don't buy total
unrealized
market.
fundamentals
We're
are not
certainly
keeping
not.
up.
Unrealized
We're not
profit
big
shouldn't be
fans of-
spent. That's what he's saying.
Yeah.
Yeah.
We're not buying.
guess
We're not
usually
buying the market. We're buying sectors inside of the market. Our managers are buying stocks inside of those sectors. So, I think Drew and I agree there are selective opportunities to be had. Certainly, maintaining a well-diversified portfolio makes sense. But I would certainly worry about just parking all new incoming cash. Look at the healthcare sector. You're getting lower risk, higher return, driven by earnings and fundamentals, not by geopolitics whatsoever. That would certainly be an area that I'd recommend Drew look to for his clients.
The major market averages clearly don't tell the whole story here. I mean, Janet Yellen didn't say the market had irrational exuberance. She said certain sectors of the market were challenging and problematic, like social media and small biotech. So I think you have to make the distinction here.
You do have a bifurcation inside the market. You have those stocks that are performing well and those stocks that are not.
Right.
What you really want to look at, and when it comes down to it, is free cash flow. If you have companies that are manufacturing earnings by buybacks or they're not experiencing revenue growth, then those are the companies you want to stay away from. Those are the companies that are going to get hurt as soon as we see increased volatility.
All right.
Look for companies that have free cash flow. If you don't buy those, you're taking an inordinate amount of risk.
I'm shocked he's adding to the 10.6 trillion around the world that's already sitting in cash. So that's amazing.
Got to put it somewhere. Thank you all, folks, very much. By the way, I'd love to know what Janet Yellen thinks is undervalued right now. I'd like to get her opinion on that. See. Thank you all for joining us. The California Public Employees Retirement System, better known as CalPERS,